I'm Chris Preston,
I'm Brad Simmerman.
and welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. Now in its 55th year of delivering investment advice. Actually, no, completed 55 years. We're 55 years in to delivering investment advice to individual investors since 1970. Uh, yeah, just saying 2025 out loud is hard to believe, but here we are. One thing is nice. I did something that's extremely timeless. Could have happened almost 100 years ago. Last night with my 10-year-old son, I brought him to see the Harlem Globetrotters, which
Oh,
were in
nice.
Vermont. And they're as good as I remember them when I was probably 10. I think that might have been the last time I saw them. Really entertaining, fun. Yeah, they date back to like I think they started as Chicago something in the mid 1920s and the 1930s when they became the Globetrotters. But
Do they
let's
still
see.
play the Washington Generals?
They still play. Yeah, Washington Generals is still 0 for 100 years, I think. I was just thinking about it. It must be tough to be a general. I think it's clearly they're all friends, but if you're on the losing team every time, it's got to be tough. Maybe you graduate to become a Globetrotter after years of.
No, no.
I don't know.
It's like with wrestling where you're just a jobber forever. Where it's like, hey, you go
True.
out, you get beat up, you make Stone Cold look good, or you make I don't even know who wrestlers these days are. Your job is to make these guys
Yeah.
look good. You will never be a face, you'll never be a pro, but you'll get
Right.
paid to do what you love, which is lose every night to the Harlem
I
Globetrotters.
know. Yeah, the players on the Generals are pretty good, but they're not doing the tricks that the Globetrotters are doing, which are still very impressive. And my son loves it. He got a photo with Too Tall, who was his favorite player. He's about 5'5", 5'6", but really good with the trick shots, and got his autograph, and yeah, he's happy. But it's nice to see something that one thing that has not changed. But a lot has, and we'll get to what's going on in the investment world, what's changed in the last 2 weeks since we did our last podcast. So, Brad, why don't you give people the rundown?
All right, yeah. So we will start with what's happening in the markets. Santa rally seems to have been absent in the last five trading days. I mean, we're still in the midst of day five, so I guess if the S&P rallies 3%, then Santa rally arrived. But what does that point towards for the future? We're going to talk a little bit about Tesla, specifically their delivery numbers came in, and we are going to talk about Hindenburg Research short report on Carvana, which the internet has been clamoring for a long time, and they finally got. And then after that, we're going to look at eight financial New Year's resolutions. A couple of them are personal, a couple of them are just good advice, but we'll dive into that a little bit later. Before we do, Chris, it's been a while. Our last episode, no take because we had a guest. The episode before that, we were paying for takes, so it's been like a month since any of us had to defend a take.
Probably for the best.
Yours, what's that?
Probably for the best, but yeah, go
Yeah.
ahead.
So yours this week, S&P will be down in January, but up more than 10% this year. You have 90 seconds. You may begin.
Yeah, so I mean, the trend of the market is down. It was a bad December. I mean, plain and simple. December historically is one of the 2 or 3 best months on the calendar. Um, Major indexes were down. S&P and Nasdaq were down, 2%, 2.5%. But under the surface, it was bad. Equal weight index down 6.6% in December. Small caps, Russell 2000 down 7.7%. 80% of the New York Stock Exchange and S&P are, this is the Mike Santolo stat from today, are now at or below their 50-day lines. So I think that's going to spread. Magnificent Seven, as usual, over the last 2 years, propped up the market, which is why S&P and Nasdaq performed better than all those other indexes and the Dow. I think they can only prop it up for so long. I think that we're going to have a few more down weeks here, and I think January will be down, maybe even more in the major indexes than December. But I do think that the bull market is still intact. There's still plenty to like about the market now and going forward for the next 12 months. And I think we'll be up more than 10% this year. Not the 20+% that we've seen the last couple of years. I think 10%, and I think it'll be a healthier 10% than it's been for most of the last 2 years, and meaning that all more corners of the market will feel the buying. But you got to hang in there for the next month at least.
All right. Time. You little bit short. I think we're just out of practice.
It's hard to tell. Yeah, I thought I was over, if anything. Okay, well, I'll expand on it a bit. I'll expand on the why I think the market will be up 10% more or more in this year. I mean, we talked about it before. There's not we haven't seen the signs of over exuberance, that you've seen that's sort of like the hint of a bull market running on fumes. I mean, for one, the bull market's what, 25, 26 months old now, which is less than half of the average bull market. The average bull market is like 63 months, something like that. So that's one. Um, I just keep coming back to, small caps, which I just mentioned, had a bad, after gaining momentum, it had a bad December. They're still down. The Russell 2000 is still down from its 2021 highs. Equal weight index is only 6-7% higher than its late 2021 highs. Um, the Dow, which is maybe more representative of what's actually happening in the market, as we talked about before. That's up 17% in the last 3 years. That's not a ton. Um, it just goes to, this is this has been possibly, I can't speak to the last 100 years, but this has been possibly the biggest difference that I've felt between what actually the feel of a bull market and the numbers of a bull market. And it goes to the Mag 7 and some AI stocks that we talked about before. So I think there's room to climb for at least the next year, as long as there's no recession, which doesn't seem to be, interest rates being cut slower than anticipated, which is part of why the market is slowed here. Inflation, falling, more stubborn than the Fed would like, but continuing to fall, hopefully. Um, so everything's in place for the bull market to continue. But I think we're going through some growing pains right now, and I think that'll last at least through this month.
Yeah, there have been, there are a lot of claims that we are seeing maybe like a rotational correction or rotational recession where different industries and stuff are getting hit at disparate times. But one thing that we keep seeing that just has me, I guess, on the fence a little bit about how long this can endure is risk tends to spread out to smaller cap stocks and the rest of the market. And then when we get into a risk off environment, like we get, the AAII surveys or the bull bear ratios, all that stuff, when that comes in and it's overblown. And then when risk pulls back, it pulls back from the broad market and then refocuses in the Mag 7 and the leading tech stocks. And I I really think we need to see signs of persistent rotation to fully endorse the bull market, right? Like these are not there are not only seven companies that are benefiting from productivity growth.
No,
Now, part of me wonders if maybe it's structural. There's a lot more investors that are in ETFs that are market cap weighted. There's just more money chasing the bigger names. That could certainly explain it away. But if it was really as risk on as it sort of seems like it should be, we would expect broadening. And we've been asking for it and looking for it for as long as this podcast has been going on. I think
no,
we've been like, hey, let's look. Where's the bull market going to broaden? Where's the next sector that's going to pop? And we really haven't seen that.
not in a sustained way. We've seen bouts of it, like
Yeah,
last November through January, especially last November, December. It broadened and we had a real rally, across the board rally. And I think from the August bottom, not this year, in 2024, the August bottom through is say late November, that was, a pretty real across the board rally. But it always falls back to its comfort zone of, Google, Amazon, um, Apple, save
yeah,
us, at least of the major indexes.
yeah.
NVIDIA.
I guess this piggybacks on it a little bit. One of the things that we have seen in the last couple of years, I think for the duration of this bull market at least, um, there has been a bifurcation of economic sentiment based on where you land politically, right? So people are more polarized now. If you were a Republican for the first 2 years of the bull market, you thought the economy was in bad shape. Now, it basically flips a switch at the election. Now that Trump is president-elect, uh, Republicans are sort of more on board with the economy, and Democrats are worried about it. I do wonder if there is maybe a Venn diagram of I need to be invested. I'm worried about the economy because of what my political biases are. All right, I'll just go buy Apple, or all right, I'll just go buy the one obvious thing.
Yeah.
And I wonder if maybe there's a Venn diagram effect. That's the best way that I can sort of position it. I mean, obviously, what we would want to see is just like people looking for opportunity all through the market, sort of regardless of polarization or any of that stuff. But it feels off in a way that even like the dot-com bubble, when we were fully risk on, it was the big names were leading the way. Cisco obviously was like the biggest beneficiary there, but then anything that was dot-com was blowing up. And we see that maybe a little bit with like pops in space stuff, pops in quantum, pops in AI, but I don't know. Maybe I don't remember the dot-com bubble well enough to really use that as a comparison point.
I
But
don't.
it doesn't seem like it's been as robust of a bull market as what the returns have been. Right?
Yeah,
S&P
yeah,
is
it
up
seems like
50% in 2 years.
AI has been a real catalyst that's lifted up a lot, a lot of
Yeah.
AI related stocks or AI, on the periphery of AI stocks, but it hasn't been, that's just one catalyst. There hasn't been enough to counteract high interest rates and,
Yeah.
um, high inflation until recent, more, more now it's more just stubborn inflation, and just the looming specter of the Fed. It just hasn't been enough. And we could really benefit from, in the absence of the Fed cutting rates, at a pace as fast as some expected. Um, if they only cut by 50 basis points this year, which is what their dot plot showed, we could really use a second big catalyst. You mentioned quantum computing, could be, but it's not mainstream enough in the way that AI is yet to,
And
lift a lot of boats.
yeah, I mean maybe rates alone explain it, right? Like
Yeah.
if you're getting 5% on cash and you need to generate 7% a year, you can afford to take way less risk. So you look for companies with a really high margin of safety, like big tech that are ubiquitous throughout daily life, that have huge cash balance, huge cash levels on their balance sheet. That is just as feasible as an explanation as anything that I can think of right now.
Yeah.
But
Yeah.
let's talk Santa rally. No Santa rally. Francis
Yeah. So,
rally.
yeah, I mean, I was gonna say my take is pretty much led into a lot of the first big three item, but as for the Santa rally, which is it the 6 days between Christmas and six
Uh,
trading days.
five, right? It's the last three of the last year and then the first two of the new year. Or is it seven?
Yeah, or Cliff Droke had it as I think six, but I thought it was five. But anyway, 5 to 6 days is going to be down, and usually that the theory goes that as if there's no Santa rally, that sometimes the market can be down in the ensuing year. To me, that's more hocus pocus than anything. I think what you can read into it is the no lack of a Santa rally is an extension of a rough December, and that hence my take for today, will spill over into January. There'll be a lingering sort of bad taste that goes through January. Maybe Trump's inauguration or maybe something else changes that. But I don't know. Yeah, I don't read too much into. I'm not going to say, well, no, there was no Santa rally, so markets are going to be down this year. Obviously, I'm not saying that. I don't know what you make of it.
I'm largely bullish for
Yeah.
like the balance of the year. The problem is you have the political changeover, which introduces these sort of I'll say known unknowns, right? Where it's like,
Wild cards. Yeah.
yeah, they're wild cards, and you can't. I mean, maybe something drastically changes. The safer bet is that we just sort of continue muddling along as we have for the last few years, that nothing really meaningfully changes.
But isn't that a crazy sentence to say, muddling along when the last 2 years, at least in S&P and the Nasdaq, are up 20 plus percent, but yet you're not wrong to say muddling.
Yeah, I think maybe I'm using that in the for the political landscape more than anything else, right? Because that's the catalyst, right? If we get widespread tariffs, but if the widespread tariffs are bluster, then it doesn't meaningfully increase inflation. If we continue to have like a debt ceiling in place, maybe that's a cap on spending. Realistically, if we get tax cuts for companies, that's good for bottom lines, right? So like discounting some of the bluster, I think is maybe more what I'm thinking there. Yeah, it's still early in the bull market, and we'll get to that a little bit later when we get to the New Year's resolutions. But there's nothing on the horizon that has me shaking in my boots. We
No.
talked about it what I think we talked about sentiment indicators at the end of last year, where it's like, yeah, the last time it was at the bull bear ratio or whatever the sentiment indicator was we were talking about was at like 4. It's like, yeah, the last two times it has done that was in the midst of the current bull rally.
Yeah.
And
And it didn't even quite get there this last time, I don't think. Probably was
yeah,
right around the top.
yeah, and I wouldn't be surprised if January is higher. I am carrying weight for the Bulls at least through the inauguration, and then we'll sort of see what happens then. It's really tough to try and make any kind of educated guess just with that overhang out there. But
Yeah.
I'm bullish until you give me a convincing reason to feel otherwise. Obviously, the under the surface stuff is tough,
Yeah.
but it's also the same way we've seen the market react to corrections for the last 2 years, right? It hasn't been a change of character at all
No.
for things to pull back in to the Mag 7.
No, I mean even the July and August correction, S&P down like 8% or something, Nasdaq 14%. It was a real correction. Um, it didn't change the fact those happen in bull markets, even if we get to a correction territory in the major indexes this time doesn't it won't change, my stance that the bull market is alive and well and it'll bounce back. Okay, let's get to number two in our big three. Tesla reported its full year deliveries, annual deliveries for 2024, which were down for the first time in their history, I believe,
The decade.
in a decade. Okay. This has 13-year low. I don't know. But regardless, so Tesla stock is down like 13% or something like that. And granted, it had risen to new all-time highs shortly prior to that. But Tesla has been kind of running on vibes since the election. Basically the premise is Elon Musk is part of, is sort of Trump's right-hand man, or in a way, that's the perception at least. He's been, nominated to the cabinet in some newly created position. Therefore, that must be good for Tesla. A Trump presidency must be good for Tesla, and that may be true. But right now, Tesla's still, an EV maker, and it relies on selling EVs. And there are a number of problems. Just the general rise of hybrids that we talked about on here, or the shift to hybrids. People just aren't ready to go in with 2 feet into just getting pure electric vehicles. That's one. There's been reduced subsidies in Europe was one thing. High borrowing costs certainly haven't helped. And also, here's one key one, I think. There haven't been Tesla hasn't created many new vehicles aside from the Cybertruck, which has been met with mixed reception. I mean, to me, I have a someone who lives in my street has one. This is the ugliest car I've ever seen in my life. But maybe some people feel differently. Um, so, one analyst said that may have reached a saturation point in terms of sales until they needed to create something new. And now they have things like the self-driving taxi, and autonomous driving is a big part of their future and what Elon wants to shift to AI also. But until that happens, people have to see growth in the actual numbers and what's actually happening rather than promises. And while this pullback, I still believe in Tesla. It's still in stock of the week portfolio as it has been for 13 years, up 23,000% since then. Not bad. So I'm still a believer in Tesla, and buying this pullback isn't the worst idea, but I think it was. I had a feeling that the rally was unsustainable. I mean, it doubled basically was it doubled from the election until a few weeks ago, or maybe it was a little before the election. Um, and it's still up more than 50% since the election. But I think that was unsustainable, and I had a feeling that the sort of comeuppance, at least in the short term, was going to be the reality of the numbers, and in this case, the numbers are actually down year over year.
So it more than doubled between October 23rd and
Yeah,
mid-December.
yeah,
It didn't quite double since right before the election.
yeah,
But it got very close.
yeah,
My only pushback on criticizing Tesla for deliveries is my perma bear, which is they trade at 100 times earnings. Ford trades at 10. They're worth more than the next, what, like 20 automakers behind them. They have never, they have always been valued based on what the company could do, and they've
hmm
never really been valued on as a car maker. If they were valued as a car maker, there's one analyst out there who has a price target of like $27 a share for Tesla.
yeah. That's
It's like
ridiculous.
CJR Research. It's something like that.
Yeah,
Um, and the reason he does is he says, look, if you value this like you would value GM, Ford, Toyota, or not Toyota because they have a bunch of other um, motors and battery tech and stuff they work on, then it should be trading around this level. So the thing with, I mean, Tesla is also, I don't know how much of SpaceX is owned by Tesla. I don't know how much Twitter structurally is owned by Tesla. The Powerwall is, I think they're working on like um, community level battery scaling in Texas, maybe. Like there's a
yeah,
lot of moving pieces. Deregulating self-drive could be huge. Tesla,
yeah,
I think, does have a head start, although Waymo looks really good there. The Ford Blue Cruise is fun to drive on highways, but I don't know if they can roll out like residential street self-drive. So it very much is there. There are still a lot of irons out there that could catch fire and like drive it further. But the valuation has so much been based on the potential for the future, sometimes hype. Um, Obviously, if they show that they're growing their core business and that they're still popular, like there's also that psychological element to it because you've talked about how Elon is seemingly scaring away like his core consumers just through the stuff he's doing in the public square, right? With
yeah.
taking hard right stances and denigrating people and turning Twitter into an unusable site effectively. Um, so I do think if you saw sales numbers like creep back up, that would probably reassure investors that he's not turning off that constituency or that demographic of buyers. But I am a little bit hesitant to pin too much on delivery numbers as really mattering for
Yeah,
Tesla.
I think you could say that the the post-election run-up was overdone,
Yeah,
and the post-delivery, hand wringing has also been overdone, which is why I think,
yeah.
I view it. I still rate it as a buy in stock of the week, and I feel even better about that now after this pullback. But I think the run we saw. I guess my point is there was too much promise being built in over after just 6 weeks of, Trump being
Oh
elected.
yeah. Yeah, I
Um,
think you're 100% right on that.
yeah. Okay, let's move to speaking of potentially too good to be true stocks. Well, not the Tesla is, but um, Carvana, CVNA, was just shorted by Hindenburg, the Grim Reaper of the stock market. You wrote about this today, I believe, or for next week. Um, Talk about what's going on there.
So the reason I wanted to bring this up in the podcast, yes, Monday we're going to have an article going out about this. Carvana is one that there have been like simmering allegations that the numbers don't add up, that the company doesn't pass the smell test, uh, that have been going around among investors for a long, long time, pretty much for as long as it's existed. Just for some context, it's a $44 billion company, or it was at the time of the publication of the short report. It was a pandemic darling. It rose 3,200% from when it IPO'd until late fall, or I guess early fall in 2021 when it peaked. It dropped 98% or 99% into the end of 2022. And in the 2 years since then, it's up another 3,900%. The criticisms of it is all of their numbers are seemingly too good to be true. They make too much from selling vehicles. They pay too much when they're buying vehicles. And sort of against that backdrop, the father of their CEO is a major shareholder. He sold 3.6 billion worth of the stock between August of 2020 and August of 2021. And then once he stopped selling, the numbers got worse. The stock dropped at 99%, and there were concerns about bankruptcy. And then once he wanted to start selling again, sold another 1.4 billion um, last year, I believe. The stock has once again started skyrocketing. We've talked about Hindenburg a little bit. I think we talked about it in October when they issued a short report on Roblox that I was critical of, and the stock's up 45% since they did their short report. I think the market is critical of it too. But this one is one that has persistently been it doesn't pass the smell test for me. It's also impossible to short because it is an absolute freight train when it gets going.
Yeah.
What I wanted to bring up is the prospect of trying to short it and looking for a catalyst. So one of the core claims is that they are using essentially subprime lending standards. So they're generating financing, they're creating financing for subprime borrowers, and then they are selling that all off. A lot of it is going to Ally. It was as much as
Ally
right.
Financial.
Yeah, a lot of it was going to Ally Financial. They were seemingly the only person that would buy Carvana's asset-backed securities, so these loans that they'd originated. It grew from 5% of Ally's consumer auto portfolio to 8.4%. So it is taking up a larger and larger share of Ally's portfolio. One thing that Carvana has done that raised some red flags is they were redacting a bunch of their agreements with Ally. But Ally's purchase commitment to Carvana expires in January, so in this month. Um, Meaning if they are going to have to hold more of these subprime loans on their balance sheet, they're going to have to start doing it soon. That is like a meaningful catalyst. If I highly recommend if you're considering shorting it, reading the full report. It's hindenburgresearch.com/Carvana. Um, but if you're considering it, you have a ticking clock because the expiration of the Ally purchase agreement could be a major difference maker as far as the share price is concerned. Dropped like 25% in the last month, but like I said, it's up 300% in the last year.
Yeah.
It does seem to be a freight train in both directions. So on the run
Correct.
up and then heading south. Uh, I would say if you were looking to short it, do so this month. One of the things that they've started doing because they can't continue to sell to Ally is Hindenburg found in some of their research that they were selling to Cerberus Capital, So they were publicly saying we're selling these originated loans to unrelated third parties. Well, Cerberus is a related third party. So there are a lot of credible allegations of insider dealing, really all in the service of bumping up the share price. So the CEO's father, who has faced SEC charges in the past, so that he can sell. Uh, the whole thing stinks. I, I mean, up 3,000%, right? You can't short it arbitrarily. You can't just say, "Oh, this looks like a bad business model. I'm going to start shorting." You'll lose your shirt. But it does seem to have turned a corner, and I do think that if people are considering it, that they could maybe jump on board before the Ally Financial purchase agreement expires in January. I don't know when terms or when revised terms might come out. Like Ally could just come out and re-up it, and then that sort of that sort of puts an end to it. Not entirely, but potentially.
To your point about being a freight train, and then we need to move on. Freight train in both directions. March 2020, the stock closed at, this was, during the COVID sell-off at $29 a share. By end of 20, no, sorry, August 2021, it was up to $360 a share. Then by early 2023, no, end of 2022, it was down to $4 a share.
Yeah.
Then this past end of this past November, so 6 weeks ago, back up to 260 a share. Now it's down to sorry, it was higher than that. It was up to, yeah, no, 260, roughly 260 a share. Now it's back down to 190 a share. So the history is complete roller coaster. I wouldn't buy it right now. I think on the heels of a short report and given the stock's history, like this could be pulling back for quite a while. I know we've recommended it in the past, but that's only when it's had plenty of momentum. It has none right now.
Yeah.
I wouldn't touch the thing right now.
And their auditor has was pulled in front of Parliament in the UK and basically said our job is not to go out and find crimes. That's not what we do.
Yeah.
Um, I mean, I am sort of tiptoeing around specific language here, but it looks like a sort of fully in public. I don't want to call it a pump and dump because that's loaded, but it's as if all the cards are on the table and yet the stock is still being, the accounting practices are still intentionally structured in a way to drive share prices up in a way that deviates from sort of normal market practices. Um, I do like it as a short here, but probably only into the end of January, early February, and you have to bail quick. If you try and short it and it turns around, it could blow up in your face immediately. It is super high risk, but potentially high reward. This is one Hindenburg report that I can get behind.
Yeah, the chart almost looks like the stock version of Bitcoin, or only a more extreme version.
Yeah.
Um, but you know, different from Bitcoin, it can actually fall during a bull market, which is what it's doing now. Okay, let's move on to our New Year's resolutions. We have 8 of them. We're already deep into this, so let's try and get through these quickly. Oh, my first tongue-in-cheek one, not counting towards my actual ones, is get more predictions right, so I don't have to suffer through a hot sauce episode like a few weeks ago here, where I was literally in the fetal position for like 30 minutes after we finished recording. Thanks, Madison. But my first real one. These are, some of these are investment related, some are just general finance advice. So some are more personal than others. When everyone is bullish, stop buying. Okay, so I'm not saying sell, because you never want to just prematurely sell out of things. But we've seen this may just be podcast specific. Every time we've had analysts on, and our analysts are really good and really know what they're talking about. When everyone's come on, we've had everyone saying, "Yeah, really bullish right now." After a month or two of a really good market, say like last summer, I think it was July, right before the sharp pullback that lasted in the second half of July through early August. We had 4 analysts on, and they're all, and you and I included, we're all high on the market. We've had, Mike on at times, Jacob on at times. They say, yeah, I really like the market. And almost every time it pulls back. Now, granted, they're not wrong to be, you know, bullish on the market in the intermediate to long term. Everyone's been right there. But I guess when there's same with sentiment, same, premise with sentiment. When sentiment is high, maybe too high, is time to, pull in the reins a bit. And maybe some clouds will soon form, and that's been the case. I think the next time we have a round table and everyone's like, I'm super bullish, I think that'll
Start
be.
upping your stops and taking
Yeah, I'm
profit.
not gonna start, like I said, I'm not gonna start selling, but that's a yellow light for me. So lesson learned over the last year.
Yeah, I like that one. Um, it's like the shoe shine boy, right? Like when the shoe shine boy is telling you about the hot stock pick, you don't buy it.
No,
Or in this case, your Uber driver is like the modern version of that.
right.
Um,
And we haven't, I don't think the market has reached that point. That's just why I think,
you know,
but which is why I think, we still have plenty of juice left to squeeze here, just broadly speaking. But, you know, even a bunch of analysts who really know what they're talking about. I mean, it's as Mike always says, you go with the evidence, and if the evidence is that everything is bullish, of course you're going to be bullish. But if when it becomes consensus in the way that it has a couple times over the last couple of years, is when um, my suspicions might be raised a little bit more now.
yeah. And while we're on the topic of bullishness, like 80% of the time the market's heading higher.
Hmm.
If you just have a perpetually bullish mindset, which I do not have, but if a
Yeah,
wiser person than I has a perpetually bullish mindset, you'll be right 80% of the time.
yeah,
If you're perpetually bearish, you're only right 20% of the time, just statistically based on the number of days that are up versus down in the long-term performance of the market. So
yeah.
have a bullish bias. I will piggyback on that. Trust early moves more is my first resolution. Um, we started talking about Rocket Lab and space stocks back in August.
Hmm.
And this, I mean, this will also sort of piggyback on, or this will lead into my next resolution, which we'll get to. But like, when it was $5, $6, $7, $8 a share, and it's up to $27 a share now.
Yep.
My entry price would have been a lot better if I had trusted the early move more. And my rationale behind this, especially, and this will also apply if you've got like a reversal, where maybe you're in a bear market or you're coming off a correction. Um, the fear as a bear is that the people that are buying now are going to change their minds and start selling. But the reality is more often that those people have already assessed whether that even if this goes down a little bit, I'm comfortable continuing to hold, right? The early buyers are comfortable taking losses in a way that the late buyers are not, because they're the ones that have already assessed in the midst of a downtrend whether they can get in or not. Um, by that same token, the early believers in a stock that they're bullish on are getting in at a lower entry price. If it's running up, they're not they're going to be less inclined to start taking profits early because they were early believers in the company. When it was nothing, they believed in it. So
Yeah.
I have I have plenty of profitable trades that are left on the table because I did not believe early enough in, or I did not believe in the early moves enough.
Yeah, that's good advice. Yeah, it can be tricky because you're always waiting for. In some cases, you're waiting for a bottom, and you're waiting for, as Mike says, you don't have to be first into a rally. You're you take out risk a bit more if wait for the evidence to sort of build. But yeah, with some of the stocks you're talking about, that sort of just take off out of nowhere. I think that's sound advice, to trust the early move. Um, okay, mine is we've talked about this so much, but is don't take the bait on Bitcoin at these levels. Again, when Bitcoin is down and out, or been beaten down, and yet a bull market has formed. That's the time I like it. But being a purely, I think, in bull market play at these levels, let's see, where are we now? Um,
97,000 or so right here.
yeah, 97, topped what around 100.
Wait,
Well, I think, yeah, 98 now. Um, well, I think, will Bitcoin go higher than that? Yeah, probably. Is it worth the risk of potentially what, 20, 30% upside where it could easily also be cut in half if, I don't think the bull market will end in the next year. But, it seems like Bitcoin usually is almost a precursor to the market pulling back. So it's just not worth the risk to me at these levels. So I guess this is not a lesson that I've learned the hard way. I haven't taken the bait on Bitcoin
yeah.
when it's been this inflated, but it's just more of a general lesson because I think people, especially people who are really into Bitcoin, could use this advice where, like, if you've made a profit on Bitcoin the last year as it's been, going up. I can't remember when we made, when I made the take that Bitcoin should be would double from, like, I think it was in like the 27, 28,000 range. Then I doubled down on that and I was right in both those cases, but yeah, I'm done now. And yeah, I think people who just think Bitcoin just, perpetually going to go up, maybe under the premise now that Trump's president, I think that's flawed. And I'd be very cautious at these levels.
I like Bitcoin at these levels.
What's that?
I like Bitcoin at these levels, weirdly enough. Because I think that when it gets the momentum, it can run. I don't know. I mean, I guess we'll see where we land on that. But yeah, like kid
Yeah, I mean, the bull market's
gloves
still
with
intact, so that's the case right there.
right.
Um,
But yeah, if you're going to put $100,000 into a Bitcoin, the downside risk is that it drops to 40, right? You
mhm.
lose 60% in a long weekend, right? Like the risks are so high with that. Um, all right, let's. We've been going a while. Let me jump to the first one that's just like a general finance one.
Yep.
These are not individually specific. These are just like good advice. Pay off debt, right? We talk about investing. We talk about saving for retirement. Debt is something that just costs you money by existing. Prioritize paying off debt. Um, Dave Ramsey, I don't know if he originated it, but he certainly popularized the snowball method where you take like all your minimum payments and you add them up. So if you've got three cards and you're paying $400 minimum payments, pay off the smallest one first, just make that same payment. And once the small one is gone, you take the money you were paying to the small one and you pay off the next one higher. That's a very good strategy. It gives you the benefit of like a mental victory. Mathematically, the correct strategy is instead of targeting the smallest one, you target the one with the highest interest rate because that'll save you the most money. But
Mhm.
pay off debt. Pay off debt costs you money just for existing. It's like inflation. It's like I mean, it's toxic. It ruins lives. Avoid debt if you can. Pay it off. Like there are times where it makes sense to take it. If you've got a mortgage rate at 2.3% and the prevailing cash rates are 4%, don't pay that off. But what I'm specifically talking about is like consumer debt, car
Yeah.
loans, credit cards, stuff like that. That'll kill you over time. Pay it off.
Mhm. Yep. Good advice. Um, my last investing related one, also, pretty specific, is don't. This is no disrespect to Michael Brush, who runs our Cabot Cannabis Investor, who, he's really on top of it. He's good at saying, okay, cannabis has fallen X amount, buy now. His buy signals are usually just essentially trade signals. Like he's buying a very
Yeah.
short term. Um, as someone who runs advisories that aren't cannabis specific, that's just too hard to do. So I'm saying I'm not going to buy or recommend anything cannabis related until there's an actual catalyst. There's been lots of talks about, you know, rumors of catalysts, rescheduling being the big one, but that's gotten the can on that one's been kicked down the road repeatedly. Who knows when that'll happen now? And that's what gave us so much hope about it in what was it, the second half of this last year. Seemed like, rescheduling was right around the corner. It was going to happen, it's going to happen, and then it didn't. So until there's a real catalyst in cannabis that actually happens, not is potentially going to happen, I'm out on cannabis. Again, no offense to Michael.
Yeah, no, it's good advice. Um,
I'm out on cannabis stocks, I should just say. Okay, yeah, go ahead.
all right. I'm gonna do another general financial one. Emergency savings. 3 to 6 months of emergency savings that you don't care what their returns are. You don't care if you're making 4% in a high yield savings account. You don't care if you're making 0.2% in a checking account. It doesn't matter. This money is not to create more money or generate income or anything. It is to carry you through a tough financial headache or a tough time or a job loss or a job transition or unexpected expenses. Build up 3 to 6 months worth of savings. Um, I do want to, so like the first one that I gave that was general financial was pay off debt. The second one is build up savings. Well, how do you do both? Um, you got to save more, right? You have to just commit more money to it. The one thing that I want people to sort of try and avoid, don't consider paying off debt, especially like credit card debt, to be building up your emergency savings, right? Like it's an easy mental trap. If you've
Mhm.
got a $10,000 credit card and that's your credit limit and you are carrying a $10,000 balance and you pay that down to $5,000 balance, the $5,000 worth of like credit line that you've got, that's not emergency savings. Banks will lower credit lines. They'll close accounts if you run into tough times. You need an independent 3 to 6 months worth of living expenses set aside, and you need to prioritize both. It's going to be very individually specific how you do that. Like if you're drowning in debt, maybe it's 66% you're paying off debt and 33% you're saving. But it is a thing where you have to do both. You can't rely on high credit card limits to serve as your emergency savings.
Yeah, I like that one. That's a good one, and one that comes up in my own personal life. I don't know, probably comes up in yours too, at least to
Yeah.
a certain degree. Okay, my last one is also a personal finance take. Just take advantage of free 401k matches for those of you who are still in the working world. It's free money for the company that you work for. I do it here. I imagine you do it too, Brad.
Yep.
Um, Building for retirement is super important, and this is a way to do it without having to, come out of your own pocket. Um, whatever level that is, a lot of companies, what, 3%, 6%,
Yeah.
something like that. Um, but good way to build for when you're when you're no longer in the working world, and it's just something that most companies offer. So good way to take advantage of it.
Yeah. Yeah. I want to second that one. The match is free money. So save at least the match. You can save more if you've got more income, but if you're missing out on 100% returns with every dollar you put in your 401k if you're not doing the match.
Right.
Um, my last one is personal and I guess more general too. Uh, Tim used to say it, one of his adages, bull runs can
Tim
last
Lutz.
longer than what?
Tim Lutz. Yeah. Sorry.
Yes, yeah. Former Cabot CEO, uh, bull runs can last longer than anyone expects. So this, I guess, goes hand in hand with the trust early moves more. It's trust late moves more too,
Hmm.
right? Like it's if you're in a profitable trade, it's easy to be worried about that turning into a loss or missing out on opportunity cost or whatever. But give bull runs more credit, especially if you skew bearish like I do.
Yeah. And as we said, this bull market is, first of all, as another Tim adage was, bull markets don't die of old age.
Yeah,
And this one is even old. It's not even middle aged yet. It's like I said, 63-ish months or a little over 60 months is the average bull market, and we're 26 months in. So, and especially given how thin this bull market has been for the most part, there's no reason it's certainly not gonna, if it's gonna die, it's not gonna die of old age. At least not this year. And I think Tim's full quote is, trends last longer than anyone thinks, so that can work in both directions.
Yeah.
I think that may have worked a little bit for the bear market in 2022. People are like, oh, it must turn around here, and it took a while. That especially that first year of the technical bull market took a while for a lot of stocks to join the party. So in a way, like the bearish trend was still kind of working beneath the surface. I mean, maybe even now to a certain degree still is. But yeah, I think that's a good one to live by. That, especially given that the market, as you said, over time tends to go up. And so there's a lot more bull markets than bear ones. And so, expecting this one to last for a while is a good way to, I think Tim also said it pays to be an optimist. And I think Brad,
Yep.
maybe you could use that advice occasionally. But you know, being a realist also isn't a bad thing.
No, you're just wrong a lot more if you're trying to be a realist. And if you're trying to be the smartest guy in the room, and like, oh no, this is topped out. You're gonna be wrong 80% of the time. You're gonna look really right every once in a while, but most of the time you're wrong.
Yeah. Okay, those are good New Year's resolutions. 8 of them for your go forth with that and do what you will for the next year. Thanks for joining us, and we will be back next week as we get rolling here in 2025. As always, like and subscribe, leave a comment, and we will see you next week.